Well, Japan's so-called Abenomics has met with early success, lifting the country's GDP more than forecast. Japan's economy grew by a strong 0.9% in the March quarter. If maintained, such a rate of growth would have the economy back to a healthy annual GDP increase of 3.5%. It's the first full quarter since Prime Minister Shinzo Abe launched a concerted stimulus spending combined with a torrent of money printing. Economists say the result is an early sign that Abenomics is working by boosting consumer sentiment. It certainly revived animal spirits on the Japanese stock market. The Nikkei is up 40-odd% so far this year. Well, our next guest has spent many years following the Japanese market and global markets. After a distinguished career with Morgan Stanley as their global equity strategist, and before that with ABN AMRO and BZW, Gerard Minack has decided to leave big banking behind. Well, I caught up with him for a Vale view on our hot stock markets. Gerard Minack, it's great to talk to you.
Thank you.
Now, we've got these extraordinary Japanese highs on the stock market, seen not since 2008. We've got the Dow pushing up all the time. People are talking about an equities melt up and a commodities melt down. What do you make of the rally?
Well, I think most of it's just because people think the world's going back to normal. For 4 years, we've been worried about these enormous downside risks, the lingering aftershocks from the financial crisis, the systemic overlay every time we had a macro growth scare. And
so
now,
do you think people think rallies are normal?
I think they think the world's going back to normal, and where equities were even a year ago were way undervalued absolutely, but completely undervalued relative to bonds. Now, my own view is everything looks cheap relative to treasuries because they push the yield so low. And then in the case of Japan and the US, it's not just the absence of bad news. There is good things perceived to be happening, and that's why they're the two leading global equity markets.
Do you think there are good things happening in those two markets to back it up?
I think there is in Japan. There's the best chance in 2 decades that they're turning the corner. Now, I used to watch Japan in the 1990s, so I've seen these head fakes before, but I do think some things have changed. We've got a central bank really being very aggressive. We've got corporate Japan aggressively pushing for reform. And I think Mr Abe himself is a huge change agent, partly because this is much more than just an economic issue for him. He's worried about Japan's relative economic, military and political decline. I think he's more likely to take hard decisions to turn it around.
So you're saying it's not just the dramatic easing to kickstart growth. The Abe government is actually going to really drive growth.
That's the theory. Let's see it executed, but I think you've got a better chance of seeing those big changes executed this time than we have in 2 decades. And that comes down to willing to take the hard political decisions that the LDP has not been willing to take for 2 decades, because they've got these pressing overlay of not just economic decay, but political decline, the rise of China. My own view is Mr Abe is worried that they're about to have another Commodore Perry moment. This time it won't be an American black ship going to Tokyo Harbour, it'll be a Chinese aircraft carrier, and they want to forestall that risk.
You've been doing quite a lot of work comparing the period in the lead up to, say, the 2007-8, the GFC, and the period that we're in now. How similar are those two periods, and how close are we to the edge?
Yes, that's a great question. I mean, the market seems to think we're going back to normal. I absolutely do not think we're going back to normal. In fact, I think history is repeating. The great financial crisis, the global financial crisis, in my view, was caused by having interest rates too low, too much debt, and the mispricing of risk. And the policy response is to run rates even lower, encourage a new round of re-leveraging, and I think we're seeing clear signs of risk being mispriced again. So for me, the big investment question is, as we seem to be rerunning the last cycle, are we now 2003, with 3 or 4 good years to go, or are we 2006? This may be an okay year, but we could see a great unravelling next year. My own view, I think we're closer to 2006.
You yourself say you were caught out by the idea of a correction having already happened because of this rush to yield.
Yes. I know I've been too cautious over the last 2 or 3 months. What we've seen every year for the last 3 years, of course, is macro weakness causing a scare in equity markets. I think part of the reason I've been wrong is because we don't have this bigger overlay of systemic stress because the people think the world's going back to normal. So if the world's going back to normal, a little bit of macro weakness isn't nearly as dangerous as it was last year or the year before where we thought macro weakness could have brought back GFC-type conditions.
Now, this push to yield and indeed the lower interest rates has made it a lot easier to borrow. Yes. And we've now got these situations where, like Apple, it's now possible to borrow to fund your dividend payouts to investors. Now, how sensible an idea is this from an investor viewpoint?
Well, I mean, it's the CEOs of the world playing to exactly what investors want at the moment, but it sows the seeds of its own problems. What we're seeing now is the re-leveraging of corporates. In fact, if you look at total US corporate debt at the moment, it's at all-time highs relative to GDP. And they're being incentivised to borrow some more, partly because debt's so cheap, partly because investors want yield. And the Apple deal was, I think, hugely symbolic of that drift, and I think it will continue for a while yet. This has got more legs on it until it falls over.
What will kickstart us out of, or kickstart investors away from yield and back to growth, do you think?
Well, I think the obvious upside would be, were we to see macro conditions really start to build momentum.
When you say macro conditions?
As in economic growth, in Australian context, commodity prices, then people will turn around and start to have a look at mining stocks or some of the other cyclical plays overseas that have lagged in this rally. Now, personally, I don't think that's likely this year. I think next year the risk is quite the reverse, that we see a deterioration as some of the areas that are really being pushed hard, some of them are not equity related, by the way. It's things like corporate borrowing, it's things like emerging market debt, where we're really seeing lending standards start to drop. And that, I think, could bring the whole rally to a hard end next year.
What about the use of quantitative easing around the world? There's debate now as to whether, for example, in the US, they will withdraw from quantitative easing. Do you think that'll happen, and what would be the impact?
I don't think it's likely to happen for some time. I think we need fairly decent macro conditions, good employment data, and some signs that inflation's picking up for the Fed to contemplate that. Of course, what we've got now is the Fed, who's trying to get full employment and 2% inflation, is missing on both counts. And most people, of course, focus on the unemployment numbers, but it's worth noting that the Fed's preferred inflation measure is now running at all-time lows, 1.1%. So it's missing big time on both things. So I can't see the Fed exiting, actually, for a long time. If growth picks up, then I still don't think it's an issue really to the back half of next year.
Has quantitative easing had the impact that had been hoped around the world? And if not, why not?
I don't think it has. I certainly think what the central banks did when we faced the precipice was very important. When Lehman's failed, what the Fed did by flooding the system with liquidity probably did avoid a second Great Depression. What's happened since, however, in my view, is enormous downside problems caused by flooding the system with money, asset price bubbles, renewed leverage, for very small payoff in terms of growth. In other words, they've got a very small bang for their buck. And that's in the US, where arguably it's had the most effect. Elsewhere, it's almost imperceptible that we've had any effect other than some currency debasement.
In 2007, it was the bank bubble that burst. Which asset bubble, in your view, has the thinnest skin?
This time, I think it's corporate debt and emerging market debt. And then, if that pops, then we'll see the yield play in equities. Let me give you one example of how crazy things have got in emerging market debt. Rwanda, that pillar of African stability, 3 weeks ago raised $400 million US, which is equivalent to 6% of its GDP, raised it for 10-year money to finish off a convention centre and start an airline. And it could borrow that money at less than 7%. Now, that's the sort of rate that only governments were getting 5 years ago. And now you're getting an African country, 6% of GDP in one deal, raising that sort of money. It may not blow up now, but give this whole process another year of big inflows, low rates, dropping lending standards, and I think that'll be the canary down the macro coal mine.
Now, Gerard, I see you're in your party shirt there. You're an hour away from your Morgan Stanley farewell party, but you're not fully retiring, are you?
No, I'm going to take some time off, and then I'll set up a consultancy for institutional investors. So we'll see how it goes.
So we might be able to talk to you, but perhaps on a more exclusive basis, given what they'll want from you.
That's right. We'll see. Thank you.
Gerard, Minack, thank you very much for joining us.
Thanks a lot.